Welcome back. Solid moves upwards on those U.S. indexes. We are seeing the S&P 500 topping $20 trillion for the first time ever. The Dow Jones currently sitting 0.75% higher at 20,422. So really that 20,000 level well in the distance now. One of the other movers that we are watching, certainly OPEC, its top producer Saudi Arabia has slashed production by the most in more than 8 years, boosting the cartel's compliance rate to a record high of 93%. The data compiled by Saudi Arabia show output was reduced by more than 700,000 barrels per day, lower than called for under the OPEC deal. However, the group's own analysts who compile data from external sources estimated a smaller cut of under 500,000 barrels a day. Despite the fall, oil prices slipped as much as 2% on a stronger dollar and signs of rising U.S. crude output. Well, joining us now is Tim Evans from Longleaf Trading Group, joining us from the CME in Chicago. Tim, hello to you. A pleasure to have you back with us. So when it comes to this OPEC compliance, I mean, it's largely agreed that, yes, they are complying. But which data do we believe?
Well, hi, Natalie. Nice to be with you today. Yeah, I mean, that's the million-dollar question. You know, you and I have actually talked about this a number of times over the last couple of months. And, you know, self-reporting is something that I personally am not going to have a whole lot of confidence in terms of, you know, hearing that data and making it actionable intelligence. The secondary sources obviously would provide a little more validity. And secondary sources now coming in and, you know, reporting numbers contrary to what OPEC members are reporting. You know, my personal view on it has been, you know, they can report what they want to, but at the end of the day, we're going to need to see those numbers reflected in global supplies throughout the world. You know, the numbers that I really paid attention to following the EIA's report is the OECD numbers. You know, we saw stocks decline in December. You know, but we had stocks 287 million above average levels. You know, stocks did indeed rise a bit in January, up 9. So we're well above, you know, the 5-year average. And if you're going to be using EIA's own data, you know, the only way that we are closer to the 5-year average is the 5-moving average being adjusted higher because of higher stocks this year. You know, so the data is not very promising, what I'm seeing so far.
But that said, I mean, we are seeing OPEC reporting a drop in January oil output, certainly saying it delivered 90% of pledged output curbs in January. That January output falling 890,000 barrels per day, Tim. The organization has raised slightly its 2017 oil demand growth forecast, and that's along with non-OPEC supply growth forecast. The report implying zero average surplus of oil in 2017. I mean, that in itself, I mean, does that provide some sort of bearish sentiment on oil as a whole in terms of some of those moves that we've seen? Or what is your sentiment around this?
You know, I just, based on the way OPEC is kind of presenting these numbers, I mean, the numbers just don't add up on my end. You know, if you look at I mean, even if the production cut numbers are in fact accurate and these secondary sources are inaccurate, I mean, if you look at the contribution of non-OPEC members and U.S. shale, you know, projections are that we should see an increase of about 1.15 per day. If demand for crude grows, as is being speculated, by 1.4, you know, that doesn't do a whole lot to the record stocks that are, you know, currently part of global supplies. You know, so, you know, if this continues to go that way, I think as we go toward the end of June, when we're supposed to be wrapping up this production cut deal, you know, it's not going to have the desired effect that OPEC intended when they began.
Well, that was something that I wanted to ask you about, actually. We've had the OPEC Secretary General coming through and saying that those preliminary numbers show very high level of compliance with supply cuts, confident the deal will bring down inventories to around 5-year industry average during 2017. But, and this is the big but, added that it is premature to say if supply cut deal needs to be extended beyond June. Now, again, this does come back to the whole data credibility idea, but just off the back of what we have seen so far, what do you feel would happen when we do hit June?
Well, I mean, I'm a little more cynical than that. You know, there was a a lot of optimism in terms of what OPEC could accomplish. And that optimism was needed for all the members to come together ultimately to agree on the deal that they agreed upon. You know, as we're moving forward and the participating members are in fact cutting back production. However, really all they're doing is shifting demand to U.S. shale as it's picking up that market share. You know, I don't suspect that all of these members who were willing to be part of this deal initially will continue to want to comply. You know, so I think there's a risk that the deal could fall apart if we don't begin to see the desired impact, that they were hoping to see again when they began this.
So let's talk strategy then. I mean, how are you, Tim, and how are your peers around you really looking to position with all of this in mind and with, as you flagged, that skepticism in mind?
Yeah, strategy I think is a little actually easier, which is normally not the case. You know, I mean, because trying to pick a direction in this market's difficult. I mean, it really boils down to whose data do you believe more. I can't say that I have a significant level of confidence in either data set. The one thing I do see that's very obvious is that, we have emboldened longs. We've seen the long position in the market build and build week over week. We're beginning to see the short side of the market begin to build some momentum. Last week was the first drawdown we saw in long positions, the first time in, I believe, 6 weeks. So when you get a market environment where you have emboldened longs and emboldened shorts, and the market effectively is at a standoff in a very tight trading range, typically what follows that is a very explosive expansion out of that trading range. We've seen volatility levels in the market continue to fall. That's the oil VIX. The strategy ultimately that I think will be a productive strategy is getting long volatility, finding ways in which you can benefit from a rise in oil volatility. Because I think ultimately when enough data comes in to give the market general consensus, whether up or down, that's going to be a very sizable move that, we should see a pretty dramatic expansion in oil volatility.
Certainly plenty still to come in the 5 months left of that OPEC deal. Tim, a pleasure as always to have you with us. Thank you so much.
Thanks, Natalie.